Oil hovering just over $51 a barrel, actually around 52, up slightly over the past 3 days, but still in a very steep downturn, down more than 30% from its recent high. Watching energy stocks as well. The energy select sector spider, the XLE, has been tracking crude smooth lower, although maybe to about a half as steep a loss, basically down about 15% from its high. Joining us now post 9 to talk about oil and the stocks, Oppenheimer Managing Director of Energy Research, Tim Rezvan. Also with us, Evercore Head of Energy Research, Doug Terreson. Guys, good to see you both.
Thanks. Good morning.
Doug, how do we kind of characterize where crude sits for the moment? Obviously, are we just working through some rush of near-term supply, or is this a new range for oil?
We don't think it's a new range. We think the price of oil is headed higher, but we've got real headwinds on both the demand and the supply side. On the demand side, these economic diffusion indices, or EDIs, have declined in 6 consecutive months. And I care about that because they're pretty good proxies for oil demand. So we've seen expectations for oil demand decline in 6 consecutive months as well. And that's a headwind. Just make no mistake, we have to have better economic growth for the oil market to do better. Simultaneously, we've got North American supply surprising to the upside. Then OPEC increased supply with the expectation that we'd see lower flows from Iran. U.S. issues waivers at the last minute, and so that's not going to happen. After having said that, we think that OPEC's aware of the situation at their market monitoring committee meeting a couple of weeks ago. They suggested that 1 million barrels per day of production probably needed to be cut for 2019, and quite frankly, I think they'll cut at least that amount next week at OPEC. And so if that's the outcome, then we think that the energy stocks will end up doing pretty well, but it could take a little while for the market to rebalance.
Tim, do you feel that way as well? Oil's somewhere near a near-term low at this point. What does it mean for your coverage universe, more on the exploration side of things?
Sure. I think what's interesting for the sector right now is the theme that people are looking at is resiliency. As we look to 2019, these companies have talked a lot about free cash flow neutrality and delivering prudent growth. And with the commodity under stress, it's going to be really interesting to see which companies can deliver on that message. It's a very easy dialogue from corporate management when oil is $65 to $75. But now that we're here at 50, it's going to be very difficult, and execution is going to be paramount. And investors are waiting, anticipating what 2019 budgets are going to be and how companies are going to plan to deliver a growth strategy.
Does 50 stress a significant number of big public players at this point?
It does not stress. It's important to note, if you look at 2017, WTI was at or below 50 for much of that year. So companies have kind of learned to position themselves for that environment. But the big mantra, again, has been about returning capital to shareholders and being prudent, and you just don't see a lot of free cash flow in that environment. We think companies can maintain leverage profiles, but free cash flow generation is what's going to be impacted.
So does that mean, Doug, production maybe stays the same or goes down in the U.S.? Where are we, like 11.7 million barrels a day or something right now because of the Permian?
We are pretty close to that, and it doesn't mean that production is not going to increase. It is going to increase because there's a lot of production growth in the pipeline. After having said that, I think investor focus has shifted away from growing production and instead to growing value, which is what the industry hasn't done during the past decade. And so I think to Tim's point, for those companies that have been more disciplined with their spending, promise to increase value and returns on capital, their valuation has increased. They're being rewarded in the stock market. These are the pledgers, as we refer to them. They've been the best stocks in the market. I think they're going to continue to be. We still like BP and Shell here, and ConocoPhillips on the exploration and production side. We think those will work well next year.
Even in the past week, we've gotten some downgrades of some mega caps because of weak correlation to the underlying commodity, right? Yep. So you don't chase Exxon automatically with a bullish view on crude?
So we think that a lot of these stocks have decoupled from the price of oil because higher spending led to more value destruction. So higher oil prices were negative for a lot of these companies, not positive. For the pledgers, higher oil prices were positive, not negative, and that's the reason that they've outperformed, and they're going to continue to outperform. And when I think about the big oil companies, I mean, my gosh, I've got Shell and BP at 6% dividend yields. They're repurchasing shares. They are cash flow break even at $50 per barrel. What's there to be afraid of?
Well, credit would be one thing I might be afraid of, Tim. I don't know in terms of some of these other companies. High yield, certainly its most important part is energy. Should there be concern there on the credit side?
No, we think there's very select where companies had maybe been on life support and have started to emerge. But those opportunities are few and far between. Companies that didn't have the strong asset base generally filed during the downturn. The companies that have emerged, there's been a period of extremely low interest rates. Companies have largely been able to term out debt. So we don't see a lot of imminent issues for companies in the small and mid-cap space where that's been a bigger concern.
This investor focus on, being disciplined and returning capital and things like that, does it reflect the fact that there is an overarching fear that this is the last energy cycle it's going to look like this? I mean, we're seeing the same thing in autos, right? We just don't know coming out of the next downturn what demand's going to be like, what the industry structure is going to be like. You think so?
Well, so I don't think it's the last cycle that looks this way. We think that the price that the industry needs to earn its cost of capital is probably 60 to 70, and I think that's probably where we're going to head. Simultaneously, companies have to be more judicious with shareholder funds, or they're not going to be sponsored by the investment community. We think that's what's changed, is that the investment community is after companies creating economic value, and if so, they get rewarded in the stock market. For those that are clinging to the failed strategy of their predecessors, which have been to grow production irrespective of value creation, they've been disowned. I think that's going to continue. That is different.
A little more of a maturity in the industry, I guess.
think so.
All right, Doug and Tim, thanks a lot.